A retired couple can sell over $100,000 in stock and pay zero federal capital gains tax, not reduced, but zero. And no, this isn't some loophole or aggressive tax scheme. This is the tax code working exactly as it's designed. In 2026, a married couple filing jointly can have up to $98,900 in taxable income and pay a 0% rate on their long-term capital gains. When you stack the deductions available to retirees over 65, including a brand new one most people haven't heard of yet, that number gets a lot bigger than you'd expect. I'm Mark Fonville, a certified financial planner at Covenant Wealth Advisors in Richmond, Virginia. After working with hundreds of affluent retirees, in my experience, this is one of the most underused strategies in retirement tax planning. But here's the thing most people miss. There are 3 hidden traps that can blow this up if you're not careful, and the third one catches people every single December. Today, I'm going to walk you through exactly how the 0% capital gains bracket works, including the new senior bonus deduction that went into effect last year. I'll show you the actual math dollar by dollar so you can see how much room you really have. And then I'll walk you through a real-world scenario with specific numbers, and I'll show you the 3 traps you need to watch for so this strategy doesn't backfire. And make sure you stay through to the end. I'll give you the exact checklist to run before you sell a single share. So here's what many people get wrong about the 0% capital gains bracket. They hear 0% and they think that's for people with low income, people who aren't making much money. That's not us. And I get why they think that. When you have a $2 or $3 million portfolio, the idea that you could pay zero tax on investment gains sounds like it's meant for someone else. But here's the reframe. In retirement, your income is almost entirely within your control. You choose when to take Social Security. You choose how much to withdraw from your IRA. You choose when to sell investments. Unlike your working years when your employer decided your W-2, you are now the one writing the script. And that means there's a window, specifically the years between when you stop working and when required minimum distributions start at age 73. During those gap years, your taxable income can be remarkably low, at least until RMDs and Social Security kick in. And that's when this strategy really is most powerful. The conventional wisdom says your taxes will be lower in retirement. The reality is more specific than that. Your taxes can be dramatically lower, but only if you're intentional about it. And the window doesn't stay open forever. And by the way, I'm curious, do you know what your taxable income would be if you retired tomorrow? Drop a comment down below. You might be surprised about how low it is. All right, let me show you exactly how this works for 2026. And I mean exactly, dollar for dollar. For a married couple, both age 66, filing jointly, here's what you get in deductions before a single dollar of income is taxed. First, your standard deduction. In 2026, that's $32,200 for a married couple filing jointly. Second, the additional standard deduction for being over 65. That's $1,650 per spouse, so $3,300 for a couple. And then third, and this is the new one, the senior bonus deduction from the One Big Beautiful Bill signed into law July 4th of 2025. This gives you an extra $6,000 per person if you're 65 or older. For a couple, that's $12,000. And this is an above-the-line deduction, which means you get it whether you itemize or take the standard deduction. Now add it all up, $32,200 plus $3,300 plus $12,000 equals $47,500 in total deductions. Keep in mind, these are hypothetical scenarios for illustrative purposes and do not represent actual client results. Now, the senior bonus deduction is subject to income phase-outs, which I'll explain here in a moment. Now layer on the 0% capital gains bracket. In 2026, married couples filing jointly pay zero federal tax on long-term capital gains as long as their total taxable income stays at or below $98,900. So here's the punchline. If your only income is long-term capital gains, you could have gross capital gains of up to $146,400, and after those $47,500 in deductions, your taxable income would be $98,900. Every dollar of it taxed at 0%. $146,400 in capital gains, zero federal capital gains tax. That's not a loophole. That's just math. Now, this is federal tax only. Your state may still tax capital gains. Here in Virginia, for example, that's 5.75%. Your state will clearly be different, but the federal savings alone can be substantial. Now, let me pump the brakes just for a second. That's the theoretical maximum for a couple with zero other income. Most people have some ordinary income. So let me show you what this looks like for a hypothetical example. So let's make this concrete. Picture Richard and Margaret. He's 66, she's 65, both recently retired. Richard was a doctor, ran his own spreadsheets for 30 years. Margaret was a school administrator. So here is their situation. They've got $2,847,000 total portfolio, $1.2 million in traditional IRAs, $600,000 in Roth accounts, and $1,047,000 in a taxable brokerage account. Cost basis on the brokerage account of about $620,000, so roughly $427,000 in unrealized gains. They earn about $12,000 a year in interest in non-qualified dividends. They're not collecting Social Security yet. They're just waiting until age 70. No pensions, no part-time work. They need $110,000 a year to live on. They're pretty frugal. So here's what we'd look at. They sell $110,000 from the taxable account to cover living expenses. Of that sale, roughly $46,000 is long-term capital gains based on their cost basis ratio. And here's where it gets strategic. They don't stop there. They have room in the 0% bracket to harvest additional gains. Sell shares, pay zero tax, and immediately buy them back. There's no wash sale rule on gains, only losses. So you can sell and repurchase the exact same investment the next day. So let me run the numbers for you. Ordinary income, $12,000 in interest and dividends. Senior bonus deduction, negative $12,000 above the line, wipes it out. AGI before capital gains, effectively zero. Standard deduction plus age 65 additional, $35,500. That $35,500 now offsets capital gains. So the remaining room in the 0% bracket is $88,400. So Richard and Margaret can realize up to $134,400 in long-term capital gains and pay zero federal capital gains tax. Again, this is a hypothetical illustration, but think about what that means. They sell $110,000 for living expenses, about $46,000 in gains. They still have $88,400 of room in the 0% bracket. So they harvest another $88,400 in gains, paying nothing, and reset their cost basis higher. Now, this is a decision Richard and Margaret would make together and ideally with their tax advisor because it affects their joint return and their Medicare premiums down the road. Over 5 years of doing this in the gap years, before RMDs hit at 73, they could potentially reset hundreds of thousands of dollars in cost basis. That could mean significantly less tax going forward, assuming tax laws remain favorable and they continue to manage their income carefully. So what's your situation? Are you in the gap years or are RMDs already a factor? Drop a comment below. I'd love to hear where you are on this. And if this is making you think differently about your tax situation in retirement, hit subscribe. I put out a new video every week breaking down exactly these kinds of strategies. Now let me show you why timing matters so much. Compare Richard and Margaret's situation to Tom and Lisa. Tom and Lisa are 67, just a year older, but Tom and Lisa waited to plan, or they started collecting Social Security at 62. He's getting $28,000 a year. She is getting $15,000 per year, and his traditional IRA has grown to about $1.8 million. He has a brokerage account with about $925,000. They're withdrawing about $68,000 this year from Tom's IRA for income. Tom's and Lisa's ordinary income is $43,000 Social Security, $68,000 from the IRA distribution, plus $8,000 in interest. That's $112,550 before we even touch capital gains. After his deductions, his taxable income is already around $65,050. That leaves him only roughly $33,500 of room in the 0% bracket. Richard had $134,400 of room. Tom has roughly $33,500. Same age range, similar wealth, dramatically different result. The difference isn't how much they have, it's when they planned. Now, let me be honest with you. I've seen this strategy go wrong, and when it goes wrong, it's usually one of these three things. Trap number one is the IRMAA cliff. Medicare's income-related surcharge, or IRMAA, uses your income from 2 years ago, and it operates on a cliff, not a sliding scale. So in 2026, if your modified adjusted gross income as a couple is $218,000, you pay the standard Part B premium, which is $202.90 a month. Now, cross $218,000 and you jump to $284.10. That's an extra $81.20 per month per person for all of Part B and D. So if you're harvesting gains aggressively, you need to project your MAGI 2 years forward and make sure you're not pushing yourself over an IRMAA cliff. Going over by just $1 can cost you nearly $2,000 a year in extra premiums. Now, trap number two is the Social Security tax torpedo. If you're already collecting Social Security, your capital gains count toward the combined income calculation that determines how much of your Social Security is taxable. For a couple, once combined income exceeds $44,000, up to 85% of your Social Security benefits become taxable. And that creates what tax planners call the torpedo, effective marginal tax rates that can hit 40% or higher in that zone, because every dollar of income makes more of your Social Security taxable. And this is why the gap years before Social Security, before RMDs, are just so valuable. You don't have these torpedoes to worry about. Now, trap number three is the December surprise, and this is one that catches a lot of people. You do all the math in October, you harvest your gains, you're right at the edge of the 0% bracket, and then in December, your mutual funds distribute capital gains. After a good year in the market, these distributions can be enormous. I've seen funds distribute 15% or more of their net asset value. That income hits your return whether you wanted it or not, and it can push you right out of the 0% bracket. So what's the fix? Check your fund company's estimated distribution schedule in the fall. Factor those distributions into your plan before you harvest gains. When we run this through our tax planning software with clients, we build in a buffer for exactly this reason. So here's what I do if this applies to your situation. First, calculate your projectable taxable income for the year without any capital gains. Include interest, dividends, any pension, Social Security if you're collecting, and RMDs. Second, figure out how much room you have in the 0% bracket. Take $98,900 and subtract your taxable ordinary income after deductions. Third, check the senior bonus deduction phase out. It starts reducing at $150,000 of MAGI for couples and phases out completely at $250,000. If you're near those thresholds, you have to be precise. And then fourth, look 2 years ahead. What will your MAGI be in your Medicare IRMAA calculation? Don't inadvertently jump a cliff. Fifth, check your mutual fund's estimated year-end distributions before you execute. And one more thing, this senior bonus deduction expires after 2028. So you have a defined window, 2025 through 2028, where this math is the most favorable it's likely to be. So it's worth evaluating sooner rather than later. Now, if you know another retiree or a couple approaching retirement, send them this video. Better yet, forward it to your CPA. This is the kind of strategy that really takes coordination between your financial planner and your tax advisor, and having everyone on the same page is how you make it work. Now, if you'd like to see how we can help you plan for a better retirement, we offer a complimentary retirement strategy session at Covenant Wealth Advisors. It's no obligation, just a clear discussion of your options and how we might be able to help you and your family. So just visit covenantwealthadvisors.com or use the link in the description below. We'll see you next time. Thanks so much.